Okay, in the presentation I talked about the science and evidence behind our investing proposition, and here now we're going to sketch out how this works. Okay, now you could take any stock market in the world and you can rank the stocks in one of two ways. I should just say this could be the UK stock market or it could be the global stock market. They work in exactly the same way. At one end of the spectrum, the axis, you would have large companies, and on the other end you would have smaller companies, and we talk a lot about smaller companies as we push on. Now that is a really simple and easy way to rank stocks, because you just have the shares, the number of shares in issue, times by the price, and large is on one end and small is on the other. But there's another way of ranking the stocks. What we could do is flip the axes around and we could look at relative price. And on one end of the spectrum, we would have what the academics refer to as being value stocks, and on the other end, growth stocks. But here we have a slight problem, because this measure here was really simple and straightforward. It's just simple. It's based on the number of shares in issue times the price. This one here, heaven forbid, is going to involve somebody's opinion, isn't it? Somebody's going to have to make a call on whether they think this particular stock, whatever it is cheap or expensive. Cheap stocks might be cheap because they've been through a challenging period in their sector, and they might just be cheap to buy at a particular time. But in any event, these are the four dynamics in play. Let's have a look now at where returns come from. Now, here's my matrix book. I have a copy on my MacBook and I have a physical copy, and you have a copy of this if you enroll onto my program. If we just look in my data book for a minute, but had we invested into the global stock market from 1970 all the way down until 2021, we would have got an 11.2% return on an annualised compounded basis. Who wouldn't take an 11.2% return? Now people say, well, that's quite a long time, Martin, 1970 to 2021. In the data book, we can look back over any decade, any period of time, and to just look back, for example, over the last 30 years from 1991 until the back end of 2021. We're in 2023, but for the purposes of the book, we would just go down and the return would have been 10.2%. So it's dropped by 1%. And we can look back over any period in the last 50 or so years there to see exactly what's happened. So I'm just going to leave that there for a moment. That's the reality of investing into the global stock market. Okay, where we left off in the non-cost, in the free part of the presentation, we looked at global stock market returns, and we know that by investing in the entire global market, we were able to secure a return of 11.2% on an annualised and compounded basis over the period which ran from 1970 to 2021, back end of 2021. And we also looked at 1991 to the back end of 2021, and we saw that it had dropped by just 1% to 10.2%, so still no mean feat there. But here's what I want to do. I want to now look at what happens if we tilt the portfolio towards investing into these small cap companies up here and the value cap companies over here. So let's do that. If I go to my data book and I just move over the page, what we can see here is the global small cap market. So this is just singling out the smaller cap companies over the whole market, as it were. Now, if you look back here from 1970 all the way down to 2021, you'll see that by tilting the portfolio to smaller companies, the return has, or was rather, uplifted to 14.7% annualised. That's a significant increase over just investing into the global markets. Let's look at the UK value market now. If we go back to our data book again, to 1970, all the way back to 2021, by tilting to value companies over small, it drops to 12.9%. So we've got 12.9 through the UK value market. What about the global market? Let's just go back. Large value index from 1975 in this instance all the way back to 2021. It gives us a return on a compounded annualised basis of 14.3%. So no mean feat there. So what that's telling us is if we tilt the portfolios towards small and value companies and we point a portfolio here in this top northeasterly corner, we can expose the portfolio to higher expected returns over any period of time. And sometimes, you know, perhaps looking back 50 years might be too long, too far back for people. So what we can do is look back maybe perhaps at just the last 30 years. And if we start where we've left off with the global large value index, our 1991 to the back end of 2020 return takes us to 10.9%. If we go back to where we left off with the UK value market from 91 to 2021, that's dropped to 8%. If we go back to the UK small cap market and just single out UK small cap companies from 91 to 21, we're at 10.4%. And if we go to the global market in our book and look at global small cap companies, again from 91 to 2021, we're at 11.7% on an annualised and compounded basis. And by the way, just for the record, if we were looking at the global market just on its own, our MSCI World Index here, we would be going to 1970 all the way back, and you can see where we started with an 11.2% there. But from a 1991 viewpoint, again 10.2. We looked at that earlier too. So by pointing the portfolio to that top northeasterly corner is what we do. We use science and evidence to drive what we do with our investing model, and it's through that investing model that we can secure higher expected returns for you, for our clients.